the mantras we have with what we do in our organization is we like to make it count. So that's one of the one-liners that we have. In as many things as we can do in our activity, we try to make it count. So I'm going to selfishly declare what I'm looking for from today, and that is that I'm looking to build a team in KL to help me realize some of my ambitions. And so if anyone is not doing their own startup, has ambitions, wants to be in technology, and I will pitch it a little bit more later on, please come and see one of our executive directors, Zoran, who's up there. So Zoran's going to put his hand up, and if I hope we can make it compelling that you might want to connect with us and see if we could do things together, kick down some doors, do some crazy projects, and make things happen. Okay. So that's my selfish interest, my thing. I think the thing that if can I just have a show of hands? Anyone who's doing their own thing, involved in a startup or a company now? Anyone thinking about it but still having a full-time job? And anyone who are ecosystem people who are interested in wanting to help just the ecosystem, etc., in government, in magic, in... Okay, cool. All right. So let's get started. I think if I was thinking about, is there something I should switch off? Is there a lot of feedback? Is it okay? Yeah. If I was thinking about what I would want to get out and really make it count from today, is really just to try and think about 2 or 3 things that have worked well that I'm able to share, and that it resonates with you, and you can think it through and how we should relate to what you plan to do. So first, I just want to introduce 8 Capital. 8 Capital is an investment partnership. We and our co-investors make investments into only technology companies. We invest in technology companies everywhere. We don't really decide by geography. But generally, a lot of the investments have been done out of more towards Southeast Asia. So I want to share with you what is our persona as an investor. How do we want to brand ourselves, and how do we want to behave as an investor and kind of like a money or a fund type manager representing our co-investors. So we have 3 key personalities. We want to be genuine. We like to be a genuine investor. That's our persona, right? So what I'm talking about is that we always think about the founders first, because we want to figure out what the founder is trying to achieve, what they've done leading up to the meeting with us, and how we can figure out, with them being from their perspective and their shoes, how they're going to achieve what they want. So we always think founders first, because they are the biggest risk if we were to invest in the deal. Does that make sense? Right? So it's founders first. You don't think about your fund first. You actually think about the founders first. So that's our personality. No tire kicking. We don't waste people's time. If we do get sent something, of course we didn't ask for it, but we look at it, and if we can quickly respond to someone and say, we like it, we don't like it, etc. And of course, that means they know where they stand. It's very easy. They can view us as, you're a potential investor, you're not a potential investor, you're not a potential investor, but you're a friend. You're not a potential investor, you're not going to be a friend, and you have no value to me. Or, who knows what's going to happen, but I'll keep in touch with the 8-Cap guys. But at least people should know where they stand. We want to be insightful. And being insightful means that if you've done the number of deals that you've done and built up an experience of doing things in the sector, you must have a view. So we must have a view. If someone comes to me and says, Nick, what do you think of affiliate advertising as part of a revenue model? I have to have a view. If you come to me and you say, I want to be a lead generation provider to a particular industry for fashion e-commerce, you've got to have a view. So once again, we look and think through ourselves because that kind of also, if we don't have view on certain sectors, that defines our investment capability. There are some things that we cannot invest in because I have no view. Neither of our guys have a view, so we can't do it. The next thing is that we like to share from experience where possible. Obviously, we don't have experience in everything, but we like to share from experience. So as opposed to always trying to quote TechCrunch or E27 or all these other sites or blogs, etc., our primary thing is that if we can share from our own experience, which we know is true and is accurate, we should do that first. All right? So that's our style. And thirdly, we always try and steer people as when we're in conversation and after investing, etc., towards executable ideas, right? Let's just try to not try and dream too much, you know. So as an example, sometimes when you see the pitch slides, you will always see some sort of exponential curve, and at some point in the graph, you look at it and you think, this guy just put 2x on every cell in the Excel worksheet. That's why you're bump, so you go out there. So it's not meaningful, right? How executable is that as an idea? It'll come back to bite you if you have good, savvy investors. The third thing is that we're decisive. If we say we're going to do a deal, you do a deal, and you fund it. You just get it done. You're not dragging around. You're trying to push time, asking for funky requirements, etc., playing around with term sheets, playing around with lawyers, etc. So that's our style. We're going to fund it, right? And most importantly, this is where we protect ourselves, really. We must have some understanding of the exit parameters. The more we understand the exit parameters, how we're going to make money for ourselves and our investors, the better we are, the more interested we are in making the investment. And if we have no sense of what the exit parameters are going to look like, is it a trade sale, is it IPO, what kind of multiples, what are peer comparisons, what are the regulations, regulatory environments, etc., then it makes it hard. That being said, we've also invested in some stuff where we have absolutely no idea about the exit parameters. Because it's just so cutting edge. So as an example, we invested in this company called Paofit. And what Paofit does is, essentially it's a virtual reality social running app. It's such a mouthful, you know, and it's really, really cutting edge, you know. So there are points where we don't really know what the exit parameters are going to be. Any questions on this slide? No? Okay. So up here, you'll see that we've done if you count it, there are about 30 investments. And I think towards the end of this week, we would have done about another 2. So we're at about 32 investments now. We have 2 different funds, so to speak, so like first one, second one. And the investments we've done have been quite very broad, and we've also invested with many, many different people. So one of the things that we needed to do was we needed to make sure that our real money, that means we really deploy capital, and we do a bit of a broader range. So we generally invest between $25,000 up to about, I think the maximum we've done is probably about 3 million US, so single deal, which puts us in a very wide range, right? Not that many people who do that. It's a very wide range. So these are the companies that we've invested in. Okay, here comes the fun part. So the topic today is getting funded and planning exits, right? So let's talk about the getting funded part. So now that you know how we approach, what's our approach to investing, what we want to be like, what we want to be known for, and what we've invested in. Has anyone gone onto our website to see what we've invested in prior to today? I'm just curious to know. No? Some people, okay. Right, you shout the word out, I'll talk about the word. So, first word. Sorry? Mafia, okay. Mafia is, you always hear about the PayPal, eBay mafia, correct? So basically investors, after a while, they like to co-invest with other people. So if you identify the mafia groups, people who like to do deals with each other, that will invariably help you close the round, especially when you have a deal and you can't, and a single investor can't take up the entire investment round. So understanding the dynamics of people who like to invest with each other, have had a good experience investing in each other, have done it before, and how well your lead investor can manage the mafia, right? The people he brings in, she brings in to co-invest with them. Okay, next word. Sorry, crowdfunding. We're a believer in crowdfunding. We've not done any. Although some of the investees have had crowdfunding or lead funding from angel, so someone in AngelList has led, but then we went in directly with that, so that we are directly into the deal. So definitely a fan of crowdfunding. I think it's here to stay. The risk is that in crowdfunding, the investor is pretty much a price taker. So what it means in investing when you're a price taker is, as an investor, whatever the promoters, the founders, etc., push as a valuation, and the lead investor, yes, as the crowdfunding expert, you just say, you either take it or you don't, right? So that's a risk, because we generally like to be a value investor. So that's also our persona, and I think we've had various sessions with other investors as well. We've generally felt that the best deals that keeps us asleep at night are the deals where the valuations are good, in our view. Okay, sorry, there's someone else who said. 7X. Okay, 7X is one of my favorites. So what we do is that we like to, when we make an investment to a company, the post-money valuation that we see post our round of funding, so let's say we invested 200,000 at a 2 million post-money valuation, we have to have some visibility that this company within the next 3 years is going to be able to raise capital at a post-money funding of 7 times what our entry is. So we must have visibility that business can get to about 14 million in post-money funding. That doesn't mean that we're looking for a 7x return, no, because as more funds are raised over the next few years, we get diluted. So the back of the envelope calculation for the investor, or for us, is in 3 years, we hope to be between 3 to 4x our initial investment valuation. That's 7x. Founders remuneration, very important. If you want to make an investment in a company and you don't understand what's going to drive the founder, and if the founder has any type of what is their financial picture, we're not asking for everything, but there are in times which is important where you understand the founder's financial picture. Because if you're going to come in as investors and you choke the living daylight out of the founder, right? She's got a family, etc., and you tell her that she can't take a salary for the next 2 years, you're not going to have a successful proposition. You're mad. So if you don't address what the founder's needs are financially, and you be honest with them and say, yes, it's going back to that founder's first rule, right? Then how is she or he going to perform? Because to break through from the startup to getting traction and all that is a crazy superhuman effort anyway. And to do it and as an investor, you're trying to de-risk the proposition for them by giving them funding, by giving them the support. But if you're going to choke them on their personal basis, you're crazy. You might as well be biting yourself. Next one. Okay, so let's talk about common versus preferential shares, convertible notes, etc. So we've participated in some, although we prefer equity. And in some of the deals that we've done, when we participate in a convertible note, and if we really like the business, we'll offer to also immediately get some common shares. And what I mean by common shares is that sometimes, and we've done it quite a few times, we are absolutely comfortable having common shares together with the same type of shares with the founders and the staff and the team. Which means that when we're in some ways, when we're at the negotiation table for capital raising or etc., we're actually sitting on the same side as the founders. Because the same dynamics affect us. We may have the convertible notes as well, but often in time, we're happy to take common shares too. Yeah. Because that, from an investor perspective, drives down valuation. Any other words? Real deal. The real deal. Okay. So it's about time now I tell you that anything below this line is actually what we look for in doing a deal. Most of the time, we're always looking for someone who's got a clear investment thesis. They understand what the industry standard is. How does the industry, if you're of e-commerce, if you're etc., how does the industry work? You have a clear understanding about how the industry works, and you understand the metrics. You become an industry expert in the topic, really understanding it. You spend a lot of time trying to figure out what reports, prospectuses, etc., publicly available, real information, not founders' blogs, not TechCrunch, the real stuff, which will tell you how these businesses run. What are the margins for a Groupon? What are the margins for an Amazon.com? What are the margins for all the different businesses? What is a LinkedIn margin? You want to make money? You want to make money from a marketplace? What is iProperty's margins? You want to build a marketplace business, right? So there's a lot of publicly available information. You should be leveraging on that. So these are the things that really get us to the tipping point. When what we want to do is we want to make sure that the founders are not going to keep themselves sleepless and get us sleepless. Right? We want to avoid that. So we suddenly see personality issues, etc. Like, we back off as well. Okay, any other words? Last call? No?
Yeah, you clarified that there was that line in the middle, but I still want to ask about, because you put a line there, value investing, that implies some analysis. Would you be able to shed light on what you look for, say, what analysis you do when you analyze potential?
Okay, so the context of this is that every year I do a session of an investor-only session at Echelon in Singapore. And so one of the main threats common is that if you're not value investing, you're not investing at good valuations, generally your portfolio will probably suffer. So one of the basis of being able to do deals and perform well for a portfolio is you must have a clear value investing capability. You know. So what is on top here are all the things some of the things that I thought that might interest you guys and you might want to ask about so that you can have a perspective from my side. Okay? This is the last slide on the getting funded part. So before we get into the planning exits part, any last questions here? Yeah. Sorry? Second market. So second market is important because what you want to do is, so you can go to secondmarket.com, of course, but when you look at investors who look at themselves and they say, oh, is this an investable idea? The number one, the best reference point to see if it's an investable idea is when someone else is willing to buy it after you've already invested in it. This is not follow-on reinvestment. This is second market. It means I made the first investment in the first round, second round, I'm selling you my shares as an investor. That gives you a good sense as well. So it's important to go out and look out the other players out there, whether there's a secondary market for this type of ideas, right? And that helps you plan your exits as well. Because then you can position yourself. You don't just say, my exit opportunity is a trade sale, etc., 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 right? You can talk about actual deals that have happened within your sector that are relevant, that are real, right? Okay, so I think the last point here is that the most important thing that we note through all this is getting funded, getting an idea, getting a team who want to execute, funding it, and helping them execute. The main thing we're all trying to do is we're trying to de-risk the whole proposition, right? Of course, you're going to give it funding so that they can execute, but de-risking it means actually making it reality. So on one hand, you de-risk, by de-risking it, you make it reality, right? So if everyone connected to a deal has a mindset that we are here to make sure that we do as much as possible to give every chance possible for this idea or this team, because obviously you have inflection points and you will iterate, give them the best opportunity to be able to have some level of success. So that's the idea, right? We're de-risking the proposition. Okay, so I'm going to swap hats now, and I'm going to talk about and share with you my own startup. Right? So 2.5 years ago, I decided to get back into technology. The first thing I did was to start making investments with some friends, and that was 8Cap. And about 2 years ago, so after about 6 months of investing, etc., I decided that, okay, in the back of my mind, I was thinking about what I'm going to do myself, right? And I was going to create my own company that I run on a day-to-day basis and put it together. So, decided to create a company which originally didn't have this name, but the idea was I wanted to identify, so first of all, it's enterprise software, okay? That's what I like. So my preference is enterprise software. I wanted to identify enterprise software whereby there was a large and growing addressable market. It had to have attractive fundamentals, which meant that it needed to be profitable, it needed to be staffed, people were there running the businesses over a period of time. So my personal investment thesis for myself was that I was going to buy over, that means acquire 100% of, or at minimum control, profitable enterprise technology businesses that I could understand, that I could visualize having large or growing addressable markets that were well run, which meant that they had been around for years, because in order for them to be profitable, and my requirement was they had to make, in my under my ownership, at least $500,000 US in EBIT or profit before tax. So that's my own investment thesis. I wanted to go out and buy these type of businesses with the sound financials, profit margins, and so what would then translate to me acquiring established technology solutions. Some are on cloud, some are not on cloud, some are both on cloud and also hosted, more traditional, hosted by the clients themselves. I would do two things. So I would build on their success. That means I would improve the product and the business within its own country, etc. And I would then grow them in Asia. The growth strategy was to build Asian distribution. So we bought two businesses, one in Australia and one in Canada. And we would build Asian distribution with people who already owned an Asian client base in their own respective markets. So in Malaysia, Singapore, etc., there are a lot of companies here which have reseller rights to Oracle, SAP, McAfee, etc., or Adobe, etc., etc. They are software integrators, and they sell by the packages, boxes, etc. So I want to work with these guys. And finally, I would develop solutions which will leverage Asian costs. So what was the investment thesis? The investment thesis was it had to be profitable and at least $500,000 US, because when it's $500,000 US in profit and above, it's a pretty decent business. It's not huge by any means, but it's a pretty decent business. That means it's been around for a while. That means, what does that mean? The people in place, pricing is defined, you understand the margins in the business, you understand the delivery costs, you understand the sales cycle and the sales process. That's all fairly well defined. And the businesses we acquired were, at that time, 16 and 13 years old. So these were old businesses, okay? And that was the idea. And so then what I'm doing now, and this is the time I pitch for some people to consider joining us, is that I was dying to come into Malaysia because I realized that there's a great opportunity for me to build a team of people here who, number one, they believed in software as a service, cloud, and especially from a more enterprise bent. They wanted to work with me to manage a profitable global technology group. So these cities here, we have offices. So we have about 40, 42, 43 people in different, in these cities. And one business has about 2,000 clients. Another business has very large corporate and government agencies as clients. So I thought it would be interesting to find a group of people who would believe in SaaS here and who want the opportunity to actually help me manage a group of businesses which are mature, but our core client base is actually all the way in North America and Australia, etc., and all that stuff, which I think is quite rare. Because most of the times, we're all sitting here waiting for the Western guys to buy us. But I thought there's a different opportunity. I think, well, we have gone out and bought 2 businesses from the traditional markets who normally buy our stuff. We can do that. It's not that hard, actually. Especially in technology, it's really not that hard. And I think I can build an amazing team here to help me manage it. And more importantly, they will help me grow the Asian addressable market, right? And then that means build out the Asian product of these guys to this part of the world. What are these businesses? I bought a Canadian business, and what we do is we build and maintain websites for real estate agents. It's relevant here, right? In this part of the region, no one really does it. So that's the mandate, right? As an example. And the second thing is that we're going to develop solutions that leverage Asian costs for the global client base. So we build it, we maintain our North American client base, we build up our Asian client base. Hey, all of a sudden you actually have a lot of clients in different regions, right? So if we can build out and leverage products, features, etc., that we can cater to everyone all over the world, would that be interesting? Well, we thought so, and it would be. So for the investors, the proposition was that we would buy companies that they were comfortable with, businesses that they could understand, and we would grow them in Asia. But the team that I'm building are going to be a group of people who have probably quite a rare opportunity to not be executing a foreign business in Asia. Not just that. We're actually managing from here. This is where decision-making lies to continue running this business which deliver services and products to clients in other parts of the world. All right? So let's talk about planning exits. Anybody want to start? Okay, so let me just finish with this one. So what we did was, so 2 years ago I had the idea, right? I'm going to build this type of business, and it was clear that I wanted to have a profitable company. It's just less stressful when you run a profitable business. So we bought the first business last April. We bought the second business this March, and we got listed on the stock exchange in August. Okay, so a few months, about 6 months to find the first company. Second company was a year later, and then 6 months from the second acquisition, we did the IPO. Right? So this is execution. This is real execution. Getting there, going to do it, having a clear investment thesis, bringing together investors, and going forward. Right? So that's my example of how I approached taking it to where what I've done in the last 2 years. Right? At the same time, we were making investments at A Capital, but this is really what I did on a day-to-day basis. So I was sitting down there, looking here all the time, trying to figure out, am I executing on my personal plan, right? So this is how I did it. So what we did was, and what we have today is we have a very, very modest-sized business. It's about 13, $14 million in valuation. We do about $1 million profit before tax, and we have about $1.5 million in the bank to then continue to do more acquisitions, grow our business, etc. Right? So that's what we did. Okay, let's talk about this stuff. Everyone start? Sorry? Okay, large versus small. It's important, right? When you want to sell a business or when you want to exit somehow, who do you do it with? Large guy? Small guy? There are trade-offs, right? The benefits and trade-offs. But I think in making a decision, if you're planning an exit, the most important thing when you are in this situation of large versus small is you want to see who becomes most invested in the process. This is a clear indication the large or smaller entity which becomes most invested in your process is the one that's going to really want to execute and do the deal. So the example is, for example, when Groupon was doing a lot of acquisitions and Living Social was also doing a lot of acquisitions in the region, right? There were a lot of people, including people like Kylie, etc. They were faced with the situation. Okay, so what do? Do we sell to Groupon? Do we consolidate smaller clones like us in the country? Do we come together with these guys, not buy them, but merge them because we can't afford it, come all together to fight Groupon? What do we do, right? That whole decision-making process. But I think one of the things that's important is that if you find that you have people who are going to be invested in the process, and more importantly, the smarter buyer is probably the way to go. Because in most technology exits, it is very common that there will be a performance, earn-out, etc., whereby there's an option to have a better exit should you be able to perform in the business as it exits, right? So find invested people and find a smart buyer. Yeah? 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 Sorry? Lemonade stand. Okay. Be very clear. If you're a lemonade stand, whether you're a lemonade stand, you've got to ask yourself, if you're a lemonade stand, that means you're a small business, you're a lifestyle business, etc., then you are a lemonade stand. And the valuations for a lemonade stand are different than valuations for a business which could be a lot bigger, etc. So have a clear sense and be honest with yourself. What type of businesses and what type of acquisition proposition or investment proposition are you? So if IPO, you're an investment proposition. If you're doing a trade sale, you're an acquisition proposition, right? And if you're a lemonade stand, what do you do? Even if you want to avoid being a lemonade stand, you've got to put together, layer on certain things which can be able to demonstrate an option for you to not be a lemonade stand and be a much larger growth business, etc. But at the same time, if you have a fantastic lemonade stand, why do you bother exiting it? So if you have a very good blog shop and you have phenomenal SEO, you have everything right, it just so happens that it only makes you 50,000 ringgit a year. But over time, it takes you less and less and less to maintain it. Why sell it? And even if someone was going to pay you, the market reality is 3-4 times, why sell it? Sometimes, if you know you have a lemonade stand, you shouldn't be exiting it. You should just keep it. It's probably better. Yeah. Any question? Go ahead.
Sorry, another question regarding planning of exits, right?
Yeah.
Which direction do you normally take? Do you say that, okay, when I have a startup, I push the startup towards the exit, or let's grow the startup, see how it goes, then figure out the exit? Which direction do you come from? Do you look at the exit and move towards that, or grow the startup first, then figure out where you can exit?
So ideally, this part of the world, whereby it's more copying working concepts, etc. it should be the first one. That means you already know, you have visibility what your exit metrics are. Maybe you may not have visibility of what the exit is, but you must understand what your buyer metrics are. That's important, right? So the best thing is, instead of saying, I'm going to go blind and go and figure it out later, etc., you should always understand what the biometrics should be, right? So you have some understanding, right? So even if you don't charge for your service in your marketplace, but the biometrics are number of listings, understand those biometrics, and always continually update people who may acquire you with your metrics that will resonate to the buyer, right? So the buyer understands.
Yeah.
Sorry to stop there, but if a founder has a very clear view on exit, does it make you feel like this founder is less invested in the business? Or you're like, oh wow, this founder has thought of exit?
It's wonderful. Then you're fully aligned, right? They have a clear goal, right? Because one of the most important things is accountability. So if a founder has a huge amount of clarity of where they're going to get it to and how they're going to exit from the business, then it's perfect, right? Yeah. It's scary if they're very stubborn, or they're fixated on something which is not so easy to figure out, or what they are fixated on as an exit is not realistic, right? Or too risky at that point, right? So, but if you have a good relationship with them, and you think you can work with them, then that's fine, right? You can figure it out more. But if you don't spend enough time understanding and being founders first, and the founder doesn't feel that you really care about them, etc., then when push comes to shove, they may screw you and stay crazy, So, yeah. Anything else? Questions, anyone? Any other topics? Okay, let me just talk. Yeah. M&A. Okay. M&A versus roll-ups. So sometimes in a business, if you're planning an exit, and all you think about is your business, your company, you may not be putting yourself in the best position to maximize the exit. You should look at what if you bought your second, third, fourth competitor, merge with them, etc., right? So as an investment proposition, many times it can make more sense to build and be part of a larger group. The greatest opportunity, I feel, is that most people, when it comes to these kind of things, are scared to lead the acquisition deal, to put it together, because there's a lot of work and it's a lot of risk, because a lot of times it doesn't happen. And a lot of people don't have the stamina, don't have the discipline, don't have the skill to pull it through. But if you have been the industry expert, you understand the buyer metrics, you can be the buyer first. Why don't you go and buy all those guys out? So when a bigger guy comes, you can hand it to them on a plate. And then you are the natural person, you're in the natural group that they would buy from. So I think M&A roles are very important. Right? Yeah. Sorry? Trade sale? So trade sale versus IPO. A lot of people think about it. And I feel, unfortunately, so when we started Catcher.com in that era, 99, etc., most business plans had an IPO aspiration. Today, most of the ideas that we see have trade sale aspirations. So the great opportunity to be is, I can go and buy all these people, because all they want to do is take a business from 1 million to 5 million to 10 million, and I can buy them for 10 million. And it's so much easier to build a business from 10 million to 100 million. Don't you think? So this is fantastic. Everyone wants to sell. Great, I'll buy it and I'll build it even much bigger. Because I have the energy for it, I have the drive, and I don't mind being more of the marathon runner, right? To take it really, really big. To make it count. So it's great. Everyone wants to sell. Perfect. Now I'll buy. Right? It's good to buy. Yeah. They've spent all this effort de-risking the idea, getting it to all this level, and then they just sell. I mean, it depends on where you're at, right? Where you want to be. Yeah. So there are not enough buyers, acquirers in the industry. Anyone else? Yeah. Sorry? Advisors, very important. Lawyers, accountants, people who know what they're doing. It's extremely important. When you're doing a transaction, we have seen, on one side of the transaction, we see the other guys on the other side of the transaction. And we buy, they sell. We've had guys who change lawyers 3 times. You know how expensive it is to change lawyers 3 times? Because you try to save money with the first lawyer, you want another one. The cost to do it is so high. Changing accountants midway. We've seen, both changing lawyers and changing accountants. One deal, nuts. Guys spend so much money. And the net effect is that they probably didn't get the best advice. Because their advisors weren't invested in the deal. Before they all thought, oh, shucks, I'm at risk of this guy sacking me from the deal, which invariably happened. Right? So getting the right advisors, getting the good advisors is so crucial. Right? Yeah. Broker sites. Okay, so if you wanted to buy an internet business, do you realize that there are a lot of websites where you can go and see what internet businesses are available for sale? So, there's a WordPress theme website available for sale at the moment. They do about 60,000 US in EBIT, profit before tax or earnings, whatever it is. And they want to sell the business for 120,000 US. Does this sound like a good deal? So a lot of people don't realize that as opposed to starting a business from scratch, or there is an e-commerce site which does, they essentially sell nutritional supplements online. I think they do about 250,000 US in sales, and they do 50,000 in profit, and they want to sell the business for $150,000. So broker sites are very important because broker sites, you must understand, there's a larger world out there of people who build internet businesses with the mentality that it's kind of like just me opening another cafe, or me opening another retail shop, or pasar malam shop. That's their perspective of it. They're not thinking about, I want to sell for 20 times revenue and 30 times revenue and all this kind of stuff. There's no aspiration of that. They're realistic people because they understand a particular business and they want to move that sector. So when you go to these broker sites, you will then see there are a lot of businesses for sale. And if you don't have a good sense of how they're valued and how they operate, then you might be going up the wrong path. Because you have your aspiration that your business can be worth 10 times revenue or 15 times profit before tax, etc. Whereas all these real businesses here on these broker sites will demonstrate you the true market valuation for the business. Anyway, buysell.com, I think is one of them. Okay? Any last question? Thanks.